if we were to look at the construction methodology of the, let's say, vast majority of the indices, I mean, it would be fair to say that they use market capitalization as the weighting mechanism, either solely or in conjunction with some, let's say, factor weights if it's a smart beta type index. But market cap seems to be the most heavily preferred method because it's an accident of history. The first
it literally is. This goes back into the 1920s when they were constructing the transportation average, and the precursor to the S&P 500 came about with this idea of, well, let's use market cap as a way to construct it. Of course, that is now carried through to current day.
Yeah.
So
But
basically 100 years.
And market cap was an improvement to the price weighted mechanism that is in the Dow Jones 30, as well actually in the Nikkei as well. That's why in institutions you'll use topics rather than Nikkei, but it's such a popular index that it's still quoted. So
yeah, but it comes with it though now, as we were seeing particularly in the current market, its own inherent problems. And so if you're using market cap, as we know, last year was the year of the Magnificent Seven, and we have a U.S. market now that's dominated by, I think the top 10 stocks in the S&P 500 are now about 31% of the total market capitalization. So an investor who is buying the S&P 500 index is actually getting a very heavy concentration risk in 10 stocks. So 30% of their investment is invested in 10 stocks, which isn't as diversified as one might think. One's thinking I'm getting 500 stocks. Technically you are, but by exposure you aren't.
So that leads to one particular side effect of market capitalization based weighting. I mean, it may be that market cap weighting is fine in a particular market where there is not lumpiness in a certain segment. There's not some extreme large caps, then a big, a middle, and then some tail. But we tend to see that it seems to be the case everywhere. So that'll lead to concentration. So you mentioned the concentration risk in a few securities of the total weight of the portfolio, but it gets compounded if they are from the same sector, which is in the case in the US. They may be from different sectors technically, but we know they're all sort of technology, and the sentiment that's going to drive them is going to be the sentiment on high growth tech stocks. So now you've got high concentration in a few stocks, and then they all are going to be driven by the same factor. So you're doubling your concentration risk. The S&P has returned, so there's nothing to say that it can't happen again. But the main point is that does that align with your or with an investor's risk exposures preferences? The popular indices may not be right for everyone at every point in time because of the concentration risk can lead to extreme drawdowns, as we saw in 2022. The S&P 500 fell 20%, and if you have a retirement portfolio, you may not want a big chunk in it. So that's why it may not be right for everybody all the time. Direct indexing offers a solution to improve upon index investing via aggregated vehicles such as ETFs and index funds. It's basically investing in the same index as you wish, for example, S&P 500, but you actually would buy the underlying stocks rather than an ETF or an index fund.